everybody. I'm going to quickly run through a couple slides introducing tonight while I am also admitting everybody. So we'll try and keep my attention going. Please note that if you join and you're not automatically muted, that I will mute you on our end. So welcome. I'm glad everybody's here and is able to join us tonight. My name is Sonia Bloom. I am the environmental coordinator with Foothills Forage and Grazing Association, and I will be your host tonight. We are also joined by Ryan Copithorne with Cows and Control, and we'll introduce him and tonight's subject here in the coming slides, and then let Ryan take over. So just real quick for anybody who is unfamiliar with who Foothills Forage and Grazing Association is, we are a nonprofit, grassroots producer-driven group. We are directed by a group of volunteer forage and livestock producers. There's 11 of them from across our region that put a lot of time into the association. We're grateful for them. We're also the oldest and first of the applied research forage associations across the province, which is pretty cool. What Foothills Forage and Grazing Association does specifically is that we address issues, ideas, and innovations for livestock and forage producers in kind of that south central, southwestern area of the province. We bring producers together by finding profitable and regenerative ways to produce forages. And we do that by, hosting activities mostly. We do lots of events, workshops, conferences, and webinars. The summers are spring, summer, fall's our favorite when we could do our field days. We'll do demonstration projects in partnership with producers and with her sister associations. I'm an environmental farm plan technician, and I help producers complete that process. And just a little information on that, you don't have to be a Foothills member or even a forage and livestock producer to work with me. I work with crop producers, everybody, members, non-members. So if you have questions on environmental farm plan, let me know. I also help producers demystify the funding opportunities. There's lots of opportunities. It's very complex, so I can help you walk through those programs. We are a great information network. That's one of our benefits, is this producer network that we have surrounded around us. It's one of our superpowers. We work on a monthly newsletter, and we are also present on social media. So if this sounds like the kind of group that you would like to be involved with, please do check out our website and consider becoming a member. The reason why we're here tonight is to talk a little bit about navigating insurance markets and risk webinar. In particular, the livestock price insurance was of interest with our board, and we wanted to explore that topic and broaden it a little bit more. And so we are going to be joined tonight with Ryan Copithorne from Cows and Control, and he's going to take it over from here. For our questions, please put them in the chat box and we'll get to it at the end. If it's a burning question, you can raise your hand and we can address it at that time. Ryan, you've got about a 45-minute presentation, and then we'll have 15 minutes for questions after. So I'll stop sharing and I'll let Ryan take over.
Okay. Hopefully that's up there now, is it?
Yeah, you're good to go, Ryan.
Good. Okay, well, thank you. Thanks for having me, and welcome everybody. I was asked to speak about livestock price insurance, so that's kind of what I'm going to zone in on tonight. There's other ways of protecting prices and things like that, but tonight's presentation will be mostly about price insurance, and I'm going to have some basic information for those of you who have never used it before, but there'll also be some intermediate and a little more complex stuff as well. So we'll try and get through. I'll try and get through it fairly quickly. If you have any, burning questions along the way, feel free to stop me. Otherwise, I'll just rattle on here and leave time at the end. So, basically, how I got into this business, I'm a fourth generation rancher. I spent the first half of my career ranching, but as a rancher, I really realized how volatile this business is, and the price swings in this industry are just unbelievable. And most ranchers are so busy they don't have time to do marketing. They're subjected to the vagaries of being busy all the time and never having a chance to really think through how to market and when to market. And so it was really something I wanted to focus in with my career to try and bring a service to the ranchers, because most people only have one calf crop a year to sell or one group of backgrounders or something. And if you miss your timing or if the market moves on you, it can be kind of devastating. So let's look at sort of the reasons behind why we would insure. One of the starting things that I'm looking at right now pretty hard is the 10-year cattle cycle. Um, it's never a perfect 5 years up and 5 years down, but there definitely is a cycle. And we're into this thing we're about 5 years up now since 2020 when we bottomed. This thing is getting a little long in the tooth, and it's been one of the biggest bull markets in history. In fact, I think price wise, it is the biggest bull market in history for cattle. So we have to prepare ourselves for the fact that eventually this is a cyclical business and it's going to roll over at some point. And that rollover can last a good 3 to 5 years or more. When you look at this chart going back to the 1970s, you can see that cattle cycle in motion. It's not always a perfect 5 and 5, 5 up or 5 down, but you can see that cattle cycle is pretty reliable. And here we are kind of at the top of the trading band here, going back to the 1970s. And this is usually when that top blue line is kind of like a ceiling for these things sometimes. And we're getting pretty close to the top if we're not there. This is the same chart. I've just drawn it a little differently. This is a different snapshot of the same picture, but you'll see that these markets, they have a tendency of trading in sideways patterns the longest pattern really was from the 70s to the 90s, that sort of 25-year sideways pattern where you can see that cattle cycle in there going up and down. And even within that cattle cycle, you can see 40% volatility or 50% volatility from the cycle highs to the cycle lows. So let's say if you bought your cattle at the top of the cycle and you sold them at the bottom of the cycle, you could lose half your value. So this is what we have to manage in this industry at any given time. But right now we're in a bull market, but at some point we're probably going to level out into a sideways market. And just to give you an idea of something I've been looking at is, if you look at the far left where that green or that blue circle is, in 1973, the cattle market really spiked up, and then it kind of gave everything back all in one go. It gave all the gains it had made right back, went right back to where it started from. Then a few years later, it rallied right up and made brand new highs. And then from there, it kind of drifted off, but eventually it settled into that sideways trading cycle. Well, you can actually see the similar type pattern, what happened in 2014 and 15. We had a major super spike like we did in 1973. The thing collapsed, basically gave back everything that it had given. And then, I think you all remember how that felt. But now we've come up to these new highs. And because of the short cattle numbers, I'm pretty sure we're going to stay at elevated levels. But, you can expect it to be similar to 1979, where eventually this cycle will start to drift off. And then we'll probably go into a sideways range for the next, number of years. But the volatility in that sideways range could be, quite extreme. So I tried to figure out, okay, so what does that volatility look like? What is it? Volatility basically means movement in prices. And when you look at the 7 years before this big run up, we had about a 25% volatility. So calf prices were going from $2.50 on the high side down to just under $2. And that was a flat market. And so now we've jumped up to this sort of stratospheric level of calf prices. I think we're almost at $5.50 now. So I tried to figure out, well, what would the range look like from here? And I'm pretty sure you can assume that the 2014-15 highs are probably going to be our floor. So we're looking at, if we look at that, that's about 350 on the bottom side for calves. And I'm talking 550-pound steers. So we're sitting here at 550 calves now. The range bottom could be at 350. And it doesn't happen overnight, but that could be the cycle range. So just to give you some indication of what, how much volatility you can kind of expect. I also looked at it, especially as a rancher, I looked at management, the impacts that we can do as managers running these cattle. And if you do everything right with your forage and your genetics and breeding and everything else like that, you might be able to add 50 pounds of weaning weight, and you'll add 5% more calves if you do a good job of managing your fertility and managing the cattle properly. And if the cattle look good, they might get a premium in the auction market. So you can add, $400 of calf value through good management. But what really became apparent for me was, a simple 25% market move, which I showed was fairly routine, can wipe out everything you did management wise. And this is one of the most disheartening things as a rancher, to put all that effort into, trying to improve your calf and your business, and getting wiped out by the market if you time it wrong. And so this is really kind of where I got into the business of trying to focus on this, because I think it's a huge thing that we need to focus, that's under focused on. And so when I looked at the price insurance, the calf insurance comes out in February, and most people are hedging their calves or insuring their calves to be sold in October. And so I looked at what did the prices do between February and October. And for the last 20 years, you can see that half the years it was up and half the years it was down. So if you're banking on prices getting better as your strategy of how to make money in this business, it's not a good strategy. You have to operate in sideways markets, have to understand that the markets go up, down as much as they go up. And so when I put this on a graphical perspective, it's that blue line. If I add up all the sort of the pluses and minuses of the prices in the last 20 years, it's basically sort of a flat trajectory, which is that blue line. The orange line is if you just didn't lose money in the bad years. If instead of losing like 10 or 20% on those down years, if you only lost 2% because you were hedged, or 5%, that's kind of what that orange line is. And you can see that the gains are quite amplified if you can just avoid losing money. It's not that we're going to make more money, it's that we're going to avoid losing money. And if you do that over the long haul, the returns are quite significant. You avoid those drops that, can really devastate you, those 5-year drops. If you can just keep it level or keel by hedging year to year, definitely you can improve your gains overall. Now, it's not always possible to do this perfectly, but that's the goal. When you look at what you have invested in these animals, this is the value that you have invested in an 8-weight steer. Let's say you were backgrounding steers over the winter here, and you want to take them to grass or something. You would have over $3,200 invested in that steer going to May here. And the profit margin might be $150. I mean, this year, the profit margins were extremely tight backgrounding. So a lot of the criticisms I hear about livestock price insurance is that you can't lock in your profits, or it's too low to lock in, the full value of your cattle plus your profits. But when I look at this chart, I have to ask, what are we really trying to lock in here? What we're truly trying to lock in is that investment. That blue box is all the money that you've sunk into that animal for the course of the year. The 150 is just gravy on there. So LPI generally won't lock in your profits all the time. Sometimes it might, but generally it doesn't. It's below your profit level. But as long as you're locking in the bulk of that blue line, that's what's going to keep you in business. And so just to give you an example, this is that same chart, but if we would have got tariffs, I'm pretty sure that our feeder prices would have dropped as much as $1. And, I think our calves could have got under $4 again. And so, thankfully, we didn't get the tariffs. And I've kind of pivoted the discussion today. We were going to talk about tariffs, but, for now, there isn't as much of a threat. But I think if we would have lost a full dollar off these feeders, you can see that's almost $800 a head we could have lost. And your livestock price insurance costs you, $50 a head. So that's a pretty good return for that type of scenario. If we get a turnover in this cattle cycle, a 30% drop in the course of a year, if the cycle rolls over, is pretty that's fairly normal. So that's a $900 hit right there. Or even if we go back to where prices were a few years ago, which is not hard to fathom, that's $1,000 a head. So, this livestock price insurance, $50 a head seems expensive when you're forking out the dough for the premiums. But when you look at the possible hit you could take, sometimes it pays, it makes sense. So ideally, it's really just to take the fear out of this business. We don't want producers to be worried about this market rolling over. And that's what I'm trying to help people understand with risk management, is if you get yourself hedged and protected, it takes the stress and the worry right out of this. So let's talk about livestock price insurance. And I want to say that I don't work for AFSC, and nobody pays me to promote livestock price insurance. So I'm going to give you a fairly honest approach, good and bad and ugly and whatever, but I'm really here just to talk about the product. So this is generally why you buy price insurance and how it works. If you're anticipating selling cattle in the future and you're worried about the price dropping, what the LPI does, it just locks you in a floor price. And so it may not be right at today's price, or it may not include your profits, but at least it'll hopefully be near your cost of production, where if the market goes down, you're not going to lose a pile of money. Then once you select that expiry date, you have an entire month ahead of that expiry date to decide when to claim that insurance. You can either just let it expire and they'll pay you if there's an indemnity owed, or otherwise you can make a claim within a month ahead. And if that market drops, of course, you'd pick up those LPI profits to offset your cattle losses. So this is the basic part of LPI. I'm sorry if this is repeat for some of you that might be already using the program, but we'll get into some more detail here in a bit. So there's three insurances that we can use. One is a calf insurance based on it bases on a 6-weight steer price. The feeder insurance bases on an 850-pound steer price. And then there's fed insurance for fed cattle. And so there's no such thing as heifer insurance, or you can't hedge the actual price of your cattle. All we're doing is pricing against the market averages for these steer calf prices, and hoping that your cattle will have some relation or be a derivative of those prices to some degree. Now, one thing I wanted to put out here is I think it'd be really interesting if we could get people like yourselves and everybody if we could start talking to our industry groups, AFSC, government, whatever it takes, to start looking at other types of insurance, because I'd really like to see bred cattle insurance. When we take a hit on these cattle cycles, one of the biggest hits we take is the value of our bred cattle, the value of our cow herd. And I've heard it said that agri-stability is what's supposed to take care of that, but you and I both know that agri-stability has been a challenge for the cow-calf sector. So if they would offer just a simple bred cattle insurance like this livestock price insurance, I think it would be really helpful for our industry. The other thing I'd like to ask for is heifer insurance, to see if we can actually insure heifers as well as just a steer price. And then, as we learned with this Trump ordeal, is that it'd be nice to have that sort of basis, or U.S. border risk insurance, I would call it, which all it would do is hedge the difference between a U.S. Animal and a Canadian animal. So those are things you can think about and talk about with your industry people. But I think there's a need for those products, and I think hopefully people would use them. What LPI does is, as I said earlier, is it just locks in that steer price. Generally, our prices are sort of derived from steer prices. A heifer would be a steer price minus a heifer discount type thing. And so what you're locking in is market average prices. You're not locking in your actual sale value of your cattle. And whether you buy calf insurance or feeder, you're locking in a certain base weight of cattle. So if you have something like heifers or animals that are outside of that weight range, if they're not quite 600 or they're not quite 850, then you'll have to do your own adjustments to figure out what price you're locking in. But at the end of the day, you're really just locking in a steer price, and it's a market average steer price, hoping that if the market goes down, that it's going to protect all of our cattle at that level. So it doesn't lock in your actual profits, it locks in a floor price. And you don't have to physically sell your cattle at the time of insurance expiry. There's no requirement for you to sell the cattle. You can insure the cattle and hang on to them longer. So that means if you want to insure your bred heifers, you can do that. All you have to do is own the cattle at least 60 days prior to expiry. This is what the typical table looks like. Along the top, you'll see the expiry dates. And as I said, you can claim up to a month ahead of those expiry dates. If it looks like the market tanked, before your expiry date, you would be able to make a claim up to a month ahead. On the left side, you see the strike prices. This is calf insurance. So those strike prices are in hundredweights. So the top price you can lock in there is $4.36 a pound for a 600-pound steer calf. And the table shows you the cost of the premiums. So it's 9 cents to buy, to lock in that $4.36. And so if you want to figure out your net price, you basically just take the 436 minus 9 cents. So you're essentially locking in $4.27 for a 6-weight calf. This is the same thing with the feeder insurance, except you're talking 850-pound steers. So now here, the best we can do for October as of today was $3.72, and it's going to cost you 8.5 cents to lock that in. So that's $3.72 for an 850-pound steer in October. It's going to cost you 8.5 cents to lock in that privilege to do that. Now, you can actually use feeder insurance to hedge your calves too. For some reason, they have a different formula with the calf insurance. And, sometimes the calf insurance has been trailing the feeder insurance. So when you do the calculation of taking an 8-weight down to 6-weight, you're actually locking in higher levels with the feeder insurance, and it was costing you less money to do it. So just some thoughts or ideas. But so as we said earlier, the insurance is really just locking in the steer price. But if you want to figure out what price you're locking in for your heifers or any animals you have that are outside of those weight ranges, you would have to do your own adjustments. And that can be a little complex. You might want to either just look at Canfax, look at the slide on Canfax for whatever month you're planning on selling, because that slide does change through the course of the year, and look at the heifer discounts for that time of year as well. They are kind of variable. Or you talk to people like myself or somebody that deals with that, or your order buyer. But if you look at that chart, what that is an 850-pound steer price in blue and the 650-pound heifer price in red. And you can see generally they track each other. So this is what I was saying. You can pretty much use these steer indexes to hedge your heifers and such. But every once in a while, they do kind of spread out from each other. That's why it would be nice to have heifer insurance as well. But when you look at the like in September of 2023, there was a major market drop there. There was about a 15% market drop, and everything just fell together. And this is usually what happens when a market sells off, is the correlation goes to 1. Like everything sells off equally. So even though these heifers prices might get a little different than steers once in a while, when you get in a sell-off situation, they all fall together. So you can use these insurance programs to hedge heifers and different weighted cattle. So just to give you a little idea of how to use this program, if you go on the lpi.ca website, the first thing you want to do is just go to this Apply Now button. And there's 4 forms you have to fill out. They're pretty simple forms. Most of them are just 1-pagers. And then they'll give you a number and they'll give you an account and they'll get you all set up. You just have to turn those forms into your AFSC rep and they'll get you started. Once you're in, then you can log in, use the login button there. Definitely one of the first things you want to do on the premiums and settlements link there is sign up for those emails. They'll email those tables to you on a daily basis. So that's a pretty easy first step for most people, is just get them to send you those tables. And then you can watch the insurance and see how it reacts, especially when you get crisis things like Trump tariff announcements and things like that. You can really see how that insurance moves and get a feel for it. Then they got all the information you need on the various programs there. There's lots of resources on that website. It's pretty easy to use. Once you get logged in, you'll get into a screen that looks like this, and this is where you can do your purchases and claims. And if you were wanting to purchase these animals, you would go down halfway down the page here, and I'll just blow it up for you so you can see it better. But the first thing you do is you have the option to buy either Alberta or Saskatchewan insurance. And for some reason, they don't seem to mind if you're in Alberta and you want to buy Saskatchewan insurance. They don't seem to mind that. So it doesn't matter. Whichever one's offering better prices. Right now, the Saskatchewan calf insurance, I think last I looked, it was like 10 cents higher than the Alberta insurance. It's just the way their formula works. They've got a feed component in their formula, I think, and it's making the Saskatchewan calf insurance look better than Alberta. The next, you would select your expiry date, the date that you want to insure for, and then you'd pick the index off the table. The highest usually is the best value, but you don't have to. If you want to just lock in your cost of gain, you can, and it'll figure out the premium for you. And then you'd have to figure out how many hundredweights you're looking to insure, and it'll automatically give you that premium. From that point on, they'll ask you if you want to just pay for it with a credit card, or otherwise they'll invoice you for that insurance once you decide to go ahead with it. On my website, if you go to cowsandcontrol.com, I have a tab called newsletter video. I have a tutorial here that basically walks you through how to buy LPI step by step. So if there's more you want to learn there, you can just watch that video. So if you're wondering how much do you buy, the answer to this really is it depends. It depends on what's going on with these markets a lot. I generally recommend at least 50% coverage at any time. Whenever you own cattle, you should be half hedged, regardless of market conditions. But if you're in a bull market, that may be all you need to do. If this market is trending higher, then there's no sense being 100% hedged. But if when that market starts to trend higher, closer to your expiry date or your insurance date, you can add LPI along the way. It's not a one and done system. You can buy, insurance for half your cattle and then add to it as it goes along as the market gets higher. And hopefully by the end, you're locking in a good profit. Now, if you're financing cattle or you can't afford to lose, or if you're sitting in a situation like we were like a month ago where Trump was threatening tariffs and we were potentially going to lose $1 a pound off our feeders, that's when you might go whole hog at this thing and insure 85 to 100%. And so this comes down to your risk tolerance. But generally, if I see trouble ahead, like those tariffs or whatever, I was telling clients just to load up, because LPI was the only tool you had to protect against tariff risk. And also, if you're financing cattle, you might have to be careful. It depends on your risk tolerance and what you can afford to lose. Generally, though, this is what it looks like most days, is that you buy about a half coverage and you're usually locking in a loss. LPI strike prices are not the greatest sometimes. And so you're locking in this loss, and it looks terrible. And you wonder, why would you ever lock in a loss? Well, it's really just to make sure that you don't lose more if this market drops. But then what happens is the market does this, and you'll get 2 or 3 chances along the way between when you bought it and when you want to sell these cattle to hopefully lock in a profit. So that's more of a realistic thing, especially something that happens in a sideways market. You'll have to be kind of nimble with it sometimes. This is a boring slide. I apologize, but I really just was trying to make the point here that there's no sense in insuring cattle that aren't going to be there. So make sure that you cut out your death loss, and then you factor in what your actual hedge percentage is to figure out how many head you actually want to insure, and then use your actual end weights. So if you're going to sell 550-pound calves in October, even though the LPI calf insurance is based on 6-weight calves, insure for your weights. So let's say it's 550 pounds. You would multiply that 83 head times 550 pounds. You'll get a total pound figure, and then divide that by 100, and that's your 100 weights. And that's what you're buying when you're buying this insurance is 100 weights. So you'd be buying 456 weights times whatever the premium is on the table that you were looking at. So when you look at LPI, like how does it work in theory or in reality? For this scenario, I bought some really low strike price LPI. This, I didn't spend the full $50 to lock in the top strike price. I bought LPI at a lower strike price. And so if the market would have stayed flat, the most I would have lost is the price of that insurance, right? So the person that was unhedged obviously didn't have that expense. We're out $22 compared to somebody who wasn't insuring. But if the market would have went up, we get to experience all that upside. The only thing we're out is the cost of the insurance because we obviously didn't need it. But you still get all that upside potentially. Your cattle are going up just like somebody who didn't buy insurance. But the real difference is when the market falls. This was terrible strike price. This was like lousy insurance, and yet I only lost in this scenario $100 a head. Whereas if the market fell a measly 15%, which is not unheard of, the other person that was unhedged would have lost $450 a head. And so it even amplifies if you get like a 30% drop, the most you're going to lose is what you're locked in at if you're fully insured. And so this is kind of what keeps you in business. And it doesn't take too many of these hits for you to get into real trouble in this business. So I looked at this, I was like, does this really work? How well does LPI really work in actuality? So I went right back to 2015. And there was only 2 years. This was assuming that you just bought it automatically in February for October expiry. So I'm not doing maybe the program justice because you can play around with this and time your buying and time your insurance dates and things like that. But if you just bought in February and sold in October, there was only 2 years really where you collected. But the collections were big enough to pay back your premiums over that 10 years. So even though you're paying premiums every year and only collecting the payout on 2 of them, 20% of the time, it was enough to pay back your premiums. And when you look at it in the dollars per head, there was actually a significant more return when you added up the value of being of the cattle gains plus the insurance gains, because you were avoiding that big $300 hit on that bad year that everybody else took. In 2016, the cattle dropped $500 a head. Well, you only lost $200 a head, saved yourself $300 a head, and that's all it takes to pay for the other 8 years where you're just giving your premiums away. Now, admittedly, some of the other tools I can get a much better collection rate than LPI, but at the end of the day, LPI only has to be right 20% of the time, generally, to cover a lot of your risk and to cover your expenses. So let's look at when we should be using LPI. I said earlier, I think having a base coverage of 50% is pretty standard. I would do that regardless of whenever you own cattle, you should be at least half hedged. Then you would look at your break even and profit levels next. If you can lock in near your break evens or in a profit, that definitely is going to incentivize you to buy more insurance, obviously. Then there's the seasonality of pricing. We know that seasonality is just sort of nature. Basically, the calves are born in the spring and they're sold in the fall. So most people are pricing their calves 2 weeks before they sell them in October, which is generally the low period in the markets when all the calves are coming to town. So what we're going to try and do with our insurance and our hedging programs is see if we can lock in better prices earlier. So we're sitting right now with 550 calves, which is pretty extraordinary pricing right now. I don't know if those prices are going to hold or go up or down, but I would generally say if you look at this seasonality chart, it would give you an intention to maybe try and lock those in somehow. Then there's the seasonality for 8 weights is a completely different chart. All those 5 weights in October are now 8 weights in March and April. So there's a huge supply of them in the March, April timeframe, which gives you a buy opportunity there. And then by the time summertime comes, the feedlots are full of feed and cattle are out on grass and they can't find the cattle. And the prices generally peak around that August, September window. So if you can kind of time your purchases around seasonality, it sure helps improve the rewards on that LPI. Then we always like to look at other tools as well. Like we're sitting now, like I said, with 550 calves. If you can get 550 for October by doing a forward sell on team or on DLMS or something, sometimes that's a pretty good option, as long as you can trust your whoever you're doing the contract with. If you can lock in good prices like that, it's going to be better than what you can do with insurance. But it's good to compare the different tools and have a look around. There are different ways to hedge here. Then, as I said earlier about bull and bear markets, there's no sense being 100% hedged in a bull market. So if the market's still trending up, you can edge into these insurance levels. You don't have to be fully hedged. Can you afford to lose money? Is your lender going to force you to buy LPI? Then there's currency and basis risk. And when you look at the tariffs, that was basis risk. So that was a risk of Canadian prices falling relative to US prices. And LPI locks in a Canadian price. So it takes care of currency and it takes care of basis, which would have been tariff risk. And if we have a conservative government come in on the 28th, there's a pretty good chance our dollar could start creeping up. And that's going to be possibly a headwind to our feeder prices here in Canada. So something to think about too, where LPI can be of use to you. And then, of course, the biggest thing is how much you like to sleep at night. When you can lock in at least your cost of production, it's a really reassuring thing for you to not have to worry about what the market's going to do to you for the next 6 months. This is what I was talking about with that dollar. When you price Canadian steer and use different dollar amounts, because it's always based against the futures market ultimately. And, with a strong dollar, it actually hurts the feeder prices. So every cent higher on the loonie can knock 5 cents off your feeders. It hasn't happened recently, but that's generally the pattern. And then there's this tricky thing called basis. Basis is really just comparing US and Canadian cattle when you put them in the same currency. And that basis can move around quite a bit. Sometimes our cattle are more expensive than US cattle when priced in the same currency, and sometimes they're 30 cents less. The biggest example really was BSE. And this to me is an example where I think this is the biggest selling point for LPI, because I lived through this, as many of you probably did as well. And from 1998 to 2001, we had a major rally, and our bred cattle got to $2,000, and our calves got to $2 a pound, and those were huge dollars back then. And then all of a sudden, we got an E. coli crisis, and it wasn't a crisis, but an E. coli started to hit the markets, and the markets started to sell off. But then they kind of recovered, and things were going good again. And then we get BSE right after that, 2003. And our prices went to the floor. Like we had 35-cent fed prices. And we at home here, we sold cull cows for 17 cents a pound. I couldn't believe it. I should have wrote it on the wall. Ugliest thing I ever did. But if you looked at the US prices, they just kept storming higher. And we didn't have livestock price insurance back then. If we would have had livestock price insurance, the hit to our industry would have been so much more muted if people would have been using it. It would have saved us having some sort of price protection. That's what you call basis risk. And that's what livestock price insurance does for you. The other tools like futures and options, they didn't work because the US prices were going up. We needed a made in Canada solution. And it's unfortunate we didn't have that program at the time. So these are some of your other tools where you got livestock price insurance, you got futures and options. Forward contracting is, like I said, you just list them on Team or DLMS for sale in October, for example, you list them now for future sale. Sometimes you just got to feed cattle till they work, unfortunately, and just look for an opportunity to lock in profits. And then there's natural hedges, which is some of you might be familiar with the buy sell methods and that's really when you're buying and selling cattle at the same time. They can kind of offset each other, and you don't need to hedge as hard if you're using some of those buy sell tools. So I'll just quickly run through a hedge example with you, and just to show you how you kind of look at these programs. We'll just look at a grass yearling program. This is a very simple example, just buying steers in May and selling in October. Now, the first thing you look at is that seasonality. We know we want to buy cheap and we want to sell high. So we know that there's going to be an opportunity in March, April, hopefully to lock in low prices. And generally, the market will see its highs in August, September. And so this is what we're trying to base our program around. I'm using 2021 because it was the last sort of normal year before the big run up in prices. And I'll show you, how other years looked after. But so in this scenario, you'd be doing a forward buy of those cattle for grass delivery, or you might just buy the cattle and put them in a lot, or you might buy call options or futures or something so you can lock in that buy price at those low prices in March, April. Once you own the cattle, then you'd put on your livestock price insurance, or you'd look at your other hedge tools. At this time, livestock price insurance was guaranteeing a profit for October. It was locking in a guaranteed profit, which is pretty nice thing to have. All you have to do is keep the cattle alive and you make money. By the time August, September comes around, we're going to look to sell those cattle, hopefully at the highs. So we're going to do a forward sell. We're going to list them on Team or DLMS for October or November delivery and hopefully capture those high prices. And then by the time the grass runs out at the end of October, we deliver the cattle, hopefully sold at the highs. Just to give you a look at that seasonality for the last 6 years, you can see those March, April lows and those August, September highs. You can almost set your clock to it. So it isn't always this perfect, but it's something fairly reliable that you can kind of use as a tool for yourself. And so that unhedged operator, they made a little bit of money because it was a slightly up year in 2021. But because we were buying low, because we were selling high, we actually picked up an LPI profit at the end as that market dropped towards when we actually, the insurance expired and we delivered the cattle. We were able to amplify the gains in an up market. Where it really matters is in the down markets. If that market would have dropped, that traditional operator loses money, whereas we still are locking in. We had those cattle locked in right from the start, and we actually picked up a huge LPI profit as that market fell, $389 a head. So just some closing thoughts. You hear a lot of chatter these days about how small the cow herd is, and we have to be very careful with that because it is true, and it is partially what's driving this market higher. But when you look at the beef production, we're still at record high levels of beef production, and we haven't seen any drops in our feedlot inventories. So we're still producing the same amount of beef, just with less cows. And the reason is because the U.S. has imported Mexican feeder cattle. We've allowed the dairy industry to infiltrate the beef industry. So we've supplemented our beef numbers with dairy cattle, and we've made these cattle bigger. So now, 10% bigger carcass weight is like having 10% less cows. So we basically swapped out cows for grain in a feedlot. And also we're more efficient. We're producing more calves per cow. These cattle grow faster. They're more productive. So all those efficiencies mean that we can produce the same amount of beef with less cows. So we have to be careful of getting too caught up in the cow number thing, as though that's going to make the cattle market go forever here. And when you look in Canada, the blue is kind of what our cow herd has done since 2005. Our cow herd is down 35%, but the orange is what our feedlot numbers are. And our feedlot numbers are still higher than they were in 2005 when we had over 1.5 million more cows than we do today. So it isn't all about cow numbers. We're very, very productive right now in our industry, and that's something to be careful of, because when you look at the U.S. cattle on feed numbers, they're really flat. They've been flat for the last 5 years. They kind of fluctuate between 11 and 12 million head based on the time of year. But look at the cattle prices. They've just gone to the moon. They've doubled and tripled in that time period. And so this isn't a supply-led rally. This is a demand-led rally. It might be kind of focused, some of the higher prices might be because people are anticipating shortages, but at the end of the day, this is demand for grain-fed beef that's causing these prices to go up. So if anything happens to that demand, we have to be careful here. Just an example, last year our calf crop was down 1% in the US, and the feedlot inventories were down, and yet our beef production was up 2%. That just speaks to the productivity that we're doing. We're producing more with less. This chart is what I'm using right now to speak to my clients about how to watch for these tops. What I've done is overlaid the price of calves and the price of 8-weight steers and the price of fed steers. And the fed steers is the red there. In the last cycle, it was the downstream players were the ones that drove the prices lower. Ultimately, the packers started losing money, so they could only afford to pay so much to the feedlot operator. So it ended up that the fed cattle turned first. And you'll notice that the feeders and the calves didn't turn until months later. It was, the fed cattle had turned and were headed lower, and the feeders and calves stayed strong and were higher. And so to me, that's kind of like the canary in the coal mine that we have to watch for here in this next cycle. Right now, the fed cattle prices are still in an uptrend, but if you look at Canadian fed prices, they haven't moved in a month. So it's, the spidey senses are tingling here. It's a little, just one of those things to keep an eye on. You can see how stretched the calf and feeder prices are relative to live cattle. That shows you that the margins aren't very good. So if we do get a turn in this market, can you lock in that 5-year drop? Can we lock in the entire 5-year downswing of the cattle cycle? And the short answer is not really. You can lock it in stages. You can lock it in, you can hedge every year as that thing drops down. But the only way to lock in that full top value is, unfortunately, selling the livestock. But it doesn't mean you have to sell the livestock. I mean, you can insure and hedge your way down and hopefully reduce that pain of that falling market when it comes eventually. So just something to think about, but you're going to want to set aside money now to do that. And generally a hedge is about 2% of your sales value. So if you just budget 2% of your calf sales or 2% of your feeder sales for using as hedging, that's probably a safe budget to use. And just be prepared to go hard at this thing. If this market looks like it's starting to roll, then put that full budget to work and plan for it. Now these prices are good. Take those dollars and put aside money into a fund for yourself for hedging or for insuring. One of the optimistic things is I don't think this cattle cycle is going to blow apart like we saw in 2016. It just can't. I mean, when you look at where our cow numbers are, when you look at who is actually going to build this herd back, the average age of the farmer is 60. The number of cattle producers in our country is down. It's been cut in half in the last 20 years. Our forage acres are down by a half in the last 20 years. So this thing is not going down anytime soon. It's going to soften, though. It will soften, but I don't think it's going to be a total sell-off like we saw in 2016. So I think you need to be prepared for, maybe breads will go back to 3,000 or 3,500. Maybe these calves will be 350 again, but it's not going back to $2, and we're not going back to $900 bread cows. I'm pretty sure of that. But famous last words. But anyways, when you look at the beef industry, there's we contribute 24 billion to Canada's economy and 6 billion to the Alberta economy. And when I see these statistics of seeing our numbers get cut in half in 20 years, I think we need to be very vocal with our industry groups and our government and population in general that we need to start focusing on this. And you people in the forage associations are doing, the greatest work here, because we can't build a cow herd without feed. And when you look at the forage acres and you look at the grassland acres in our country, how they've been reduced, we need to grow as many forages as we can. Obviously, we need to find ways to keep the competition away too. Our own government sometimes competes with us with some of the trust arrangements and things like that, where they're taking land off the market for us. We need to have approaches that are very rewarding for people that do good stewardship. Plus, we need to look at risk management programs, make sure that we've got the proper risk management programs. I talked about the bred insurance and heifer insurance, and obviously getting more people on this program. I think there was only, during the tariff wars, there was only 892 people using LPI. That's not a lot of people. So we need to get more people on it and look at succession solutions as well. The average producer age is going up still. So I'll close with this slide. This is the slide I always like to close on, because it's like, when you look at grasslands and ranch lands, that is where nature lives. That's where all the animals are. That's where the birds are, and the wetlands and the trees and all the things that people call nature are on these grasslands. And the only thing that pays for nature is cows. And so, people talk about carbon credits and all these things, but so far none of that is paid. It's been the cows that have paid to keep these grasslands intact. And so if you want to know how well nature's doing in our country, we just got to count the cows. And I would say that we're in a bit of trouble, because our cow herd's down 35% in the last 20 years. So, when people start talking about the environment, we need to keep focusing on cows are a benefactor and something, or a benefit to the economy and to nature in general. So always keep that in mind. Be proud of what you do, and especially what you're doing with the forages as well. So I'll leave it there and open it up for questions. If you go to my website, I got a free newsletter. If you're not on it already, you just sign up and it's free. And I just basically talk about markets and that type of thing. And I'm glad to take questions.